I want to thank you for joining us here at the One-to-One Mining and Energy Investment Singapore event. We're happy to be back in Singapore. Quick introduction from our panelists. Just share a little bit about yourselves for our audience.
I've been a commodity analyst strategist for 20-something years now. I started off in London at CRU and then moved to China in 2003 and just for a bit of a venture and never went home. Just lived there for 11 years working with Rio and Macquarie, CLSA. Was down here for 7 years and then been in Japan for the last 3 years. So very much just on the, so it used to be a sell side, now more kind of independent analysis. So not an investor directly, but all my clients are investors. So hopefully give some perspective on kind of where we see the general investor positioning and that kind of thing today.
Hi, Alberto Migliucci. I was head of mining and energy for Credit Suisse here in Asia, based in Singapore for 14 years. Investment banking background, but also have a geology degree. So try to combine the geology and the finance aspects. And now I have my own kind of boutique capital advisory group called Petra Commodities, which is based here in Sydney, and always looking for deals and things to do. I know most of the people in the audience. Thank you.
Hi, Damian, Pearson. An advisory background, so I was with Deutsche Bank for many years in Australia, and subsequently joined EMR Capital, which is a private equity investor in mining. So I've been with these guys, with EMR for about 7 years, based out of Australia and up in Hong Kong, where we opened an office about 8 years ago.
All right, great. So I would like to keep this conversation quite, conversational and free-flowing, informal. So if at any point you do have questions or want to badger our panelists, feel free to put your hand up and we will get a microphone over to you. So I guess to kick it off, let's talk a little bit about some of these kind of the global macro factors impacting today's metal market. So what are some of the biggest impacts that you're noting right now? Maybe Ian, if you want to kick us off.
Obviously, the number one thing is China is the big kind of axe hanging over us at the moment. We obviously had the super cycle of the 2000s, early 2010s, then a bit of a pause, then we had supply side reforms, kind of 16 through to COVID, and now kind of the China bubbles well and truly burst, and that's really hit the commodities sentiment. Certainly from an investment side of things, I think joke as kind of analysts, it's like, this fund's shut down, or this person's left, or this must be the bottom of the cycle, it's got to turn around soon. And it's just, it's been years and years like that now. Whereas, of course, this year's been quite a spectacular year with the record high prices we saw in May. Some of that kind of very fast money coming in on the data centers and AI and all of that stuff, looking for second or third derivatives of that story. So buying copper and such like, but yeah, that lasted 5 minutes when they started looking at the fundamentals. And now we're back down again. So yeah, commodities have been quite unloved for a while, but I'd say China's obviously 50% plus of most commodity demand. And that's the thing that's been hanging over us, the dark cloud, for so long. Now, I started the year saying, actually last couple of years, China wasn't too bad. There's a lot of post-COVID support and stimulus getting through, but I started the year saying, actually, I'm more bearish on China this year than any time since 2015. It's going to be a really terrible year because she's getting really aggressive about local government debts. Just, you've spent too much money. There's nothing in the kitty. You've got to aggressively cut. And the housing market's still, further and further down, no turnaround there. And all the stimulus kind of from the COVID era fading out. And things have been even worse than I expected. It's been terrible on the construction side. Cement demand's down 11% year on year. Local government spending, infrastructure's down 5 trillion. Housing, new floor space is still down 20% after already falling kind of 60-70% in the last 3 or 4 years. So, really lacking good news. But it's not all bad news in China though, because it's really a split. If you look at the old Li Keqiang index, right, like power consumption, it's still growing 5%. Now, how do we have Chinese power consumption growing 5% when construction activity is down 11, housing's terrible, consumer sentiment's terrible, people are not spending money, FDI is ground to a halt? Well, there are still some good news stories there. I mean, number one, China, of course, has gone back to the export engine. That's always the kind of, if we're weak domestically, we'll just try and push the export engine very hard. Now, that's something they've been doing for the last couple of years, and they've saturated the world now. EVs, steel, solar panels, everything. And you're seeing increasing protectionism against China. But the good thing is at least China's now re-engaging with the world politically, trying to keep trade corridors open, trying to be friends with Australia again after being quite tough for previous years. And the other story, of course, is the green energy story, and that's still going extremely strongly in China. So where steel demand is going to be down about 5% this year on the back of that weak construction market, things like copper, aluminium are still growing 5%. Because they're able to shrug off that weakness in construction and heavy industry and housing markets, because the green energy revolution in China is still going full speed ahead. So there are some good news stories out there. The other one, which I'm super bullish on, is India, right? So having lived in China in the early 2000s, and many of you remember we used to get these old Chindia reports from lots of the banks of, hey, India's got 1 billion people, that'll do a China. And it's, go there in the 2000s, nothing was happening. It was so slow, bureaucratic. It always kind of stumbled over. Whereas post-COVID, India's really transformed. Everyone who's been doing business there, selling commodities since the COVID era has been telling me demand's through the roof. It's incredibly strong. So I went there last year for the first time since 2009. And yeah, it's just changed so much. It really is at that takeoff point now. It feels like India is where China was in the early 2000s. They've investing so much in the infrastructure, the power infrastructure, no more blackouts and brownouts always used to be a problem. The ports, the roads, now they're investing in the rails. They're actually building a Japanese bullet train network, first country outside of Japan to actually build bullet trains, massively commodity intensive. So we do have some good news stories out there in the background, but they're just not getting any love, right? Because people are so bearish on China at a headline macro side of things. And start of the year, first quarter, we were seeing, is Europe and US going to recover? Are rates going to come down? We've been through a 2-year global destocking cycle on commodities. Is that finally going to turn around? Green shoots in European growth. So there was a bit of hope at the start of the year, and that's kind of helped the prices there in 2Q. But that's all evaporated again. Right now, everyone's worried, is the US going back into recession? Fed's left it too late to cut. Europe's still a basket case. So I'd say at the moment, investor positioning is a lot more, people were very bearish China consistently for the last year plus, and now it's back to being bearish Western world as much. So the good story is the green energy story, India, the kind of positives that are out there are just not getting that much attention or that much love from the markets at the moment. But yeah, at some point, we're always known as cyclicals, so we will come back. It is a cycle. We just need people want to start looking more positively. There are plenty of positives out there.
Go ahead.
Okay, just picking up on what Ian said, on the China issue, I think pre-COVID, when I'm looking from an M&A investment point of view, you'd have China go out and invest in various countries like Canada, Australia, US, etc., and obviously Africa and Indonesia and places like that. I actually think the global geopolitical situation has changed, and it's a dichotomy now, where this kind of China and Russia and some of the sort of BRIC type countries or Middle East countries, and then there's the rest of the West, if we can call it that. And what I'm actually seeing now is, I actually feel at my level that Chinese investors aren't looking in places like Australia or Canada, obviously the US. And that wasn't the case 5 years ago. 5 years ago, when I'm sitting in quite a great mine in Australia, the Chinese are all over there, and Canada as well. So I actually think it's something higher up, where the China government have actually said, we're just now investing with countries that are aligned with us. And that goes now with this whole EV future metals revolution that we're seeing. There's a bit of a race to see who has that supremacy. It's the whole China trading bloc and their partners. And then there's the US with the IRA Act, Biden's IRA, which is kind of made in America. So you have to then deal with countries like, this benefits countries like Australia, for example. And then you've got a place like Indonesia, where China has actually virtually monopolized the nickel industry there. But Indonesia is traditionally neutral, so you can't say Indonesia's like aligned with China, although you'd probably say the DRC is aligned with China in some places in Africa, and obviously certain places in the Middle East and and obviously Russia. If you see the latest news from Indonesia now, they're actually trying to encourage Western investment as well to balance that out, even in their nickel industry. So the Indonesians are playing it probably right, as in saying, we don't want to just be tainted with, we're aligned with China from a commercial but also geopolitical view. So I actually see that that's happening. But this is probably the strongest I've seen in my career, where you really feel there's a division between these two, the world split in half, basically. So I know Ian said China's going back into Australia. I haven't seen that really. That could be just talk or politics, but I haven't seen and I'll give you an example. I was advising a company in Australia last year to get financing for this asset in New South Wales, and I went out to some of my Chinese delegation investors, and they basically told me that, you know, Australia's not on the radar for China at the moment, and neither is Canada. That was that particular group, but they did come down and kick a lot of ties and take a lot of photos and do a lot of due diligence. So, you know, on the surface, looks like there's interest, but I don't think they're. I think to make that decision, to make a, you know, a 50, 100, $200 million investment in Australia at the moment, it's a double-edged sword. Just the Aussies are sensitive, and then the Chinese. So that's what I'm seeing from that point of view. That's probably the political side. On that, the Australian Strategy Policy Institute, the ASPI, if I can say that right, after a Grand Prix weekend, they've actually came out with a report and said that China is a world leader of 90% of critical technologies. So that's a pretty amazing number. That includes defense and energy technologies, aerospace, AI. If that's the case, if the Chinese are leaders in 90% of the world's critical technologies, well, they're going to need most of the resources, right? So that's the default position. And I'm sure we'll probably talk about it a bit later, but obviously your nickels, your cobalts, your lithiums, and all those kind of metals are going to play into that. Yeah.
Okay, thanks. I mean, maybe just picking up on a couple of those themes. You know, we've got a couple of large assets. We've got a large coking coal asset, large gold asset, which we'll be exiting, you know, next year. And you know, we're sort of in pre-marketing phase, and we are seeing appetite from China in both of those assets, and that reflects probably in being in sectors which are less sensitive for investment. So I think what we're sort of seeing, and having done quite a bit of diligence, is that, you know, certainly China, is the Chinese, from a Chinese perspective, they're very worried about the fact that it's not good to be putting things up and getting turned away by another government. So I think if there's some segments like gold, like coal, where Western governments aren't going to object, then it's possible to see Chinese investment. I think anything around the battery material space, critical minerals, is actually very challenging, which, you know, creates another issue as well, because if you look at Australia, most of actually the investment and how it's been driven out and the build out of lithium, etc., has been on the back of Chinese capital. So it's going to be an interesting time around, you know, how are actually mines built, developed, if you can't bring in Chinese capital. I think the other point to pick up on, which we've seen this year, is generally that wind back in EV adoption globally. You know, clearly the projections which are out there were too bullish, and you're seeing, you know, car companies just pull that back a bit, which has impacted the demand globally for battery materials. And I think you sort of look at that, and you know, clearly there's very, very sort of depressed prices, and you couple it with what my colleague was saying, which was when you look at the battery space, there is such deep connection between the sort of processing and the upstream, and China controls that refining, and generally their expertise in refining is significantly greater than what is available in the traditional Western world, and that's another area which we're struggling. So as an investor, we look at it and we say, you know, we generally think the margins over time will, you know, kind of change between whether you're making it upstream, whether you're making it in the refining. How do we get a refining position? Do I back a startup Western technology which has been less tested, or do you try and have to do something in partnership with China? And secondly, where do I do that? So if you look at the refining, which is, you look at some of the big lithium refineries which have been built in Australia, the capital intensity is 7-8x China. Building in Indonesia is probably 2x China. At the end of the day, we have to sort of be rational, economic animals. So, that whole sort of partnership with China, the expertise, the lower capital intensity, at the end of the day is needed for EV adoption as well. At the end of the day, EVs are only going to get adopted, yes, by government policy, but also being competitive with ICE vehicles. The battery is the major cost. The materials going into the battery are the major cost of that. So that's another big thematic in the industry. And that sort of it's not just a sort of China control. I think it's the processing expertise which China has, and how does that impact and be brought into the sort of Western context for development of resources.
Good morning, everyone. Like a 5-second introduction. My name is Dinos. I actually work for Pelagic Resources. We're a trading company, so our investments have a bit of a different profile to the typical investor. So we invest to get product. We invest in offtakes. So from my perspective, our approach to investment has been, from where I sit, a bit more aligned to the Chinese type of investment. We operate mostly out of South Africa, Southern African countries, because two reasons. As I say, I'm not an expert in this field. We just find product and we mine it and we ship it out. But we deal with private companies, so we don't have to do with the overvaluation of ASX and TSX entities. So looking at a project, because we do have projects being presented to us in American jurisdictions, Australian jurisdictions, but you have to deal with an entity that's got a piece of paper and is already worth $500 million, right? Whereas dealing in South Africa or Zimbabwe is even friendlier, even though is a worse type of jurisdiction. You're dealing with private entities, few signatures, you get a project, and then you only have to worry about is the capex. And there's Chinese EPCs, Chinese equipment. So developing a project in a country such as South Africa, or one of our major buyers is Tsingshan, which is now developing that huge project out of Indonesia. Like, why would you go to Australia if it's so much more expensive? If what you really want to get out of your project is cost-efficient material and not really an expensive share price, so you're looking for a financial return, looking for a private project in a more difficult jurisdiction ends up being a better option. I mean, of course, it's been all those jurisdictions come with certain risks. A lot of companies have been burned. Chinese companies have been burned, but from what we see, we would rather take that risk rather than we need to buy out someone's $200 million stake before we even start developing a project in a developed economy. So yeah, and we still see quite a bit of, especially in Zimbabwe right now, we're looking at quite large investments from Chinese companies, Chinese state-owned, even Chinese private. We're also looking at investments, and these are all in chrome. We see investments still in lithium, hard rock lithium. That's still, I thought that was a dead industry, to be honest, but that still to be quite a bit of interest. Vanadium, and the only people in the market, they seem to be Chinese investors. So we do see what you guys are seeing. I mean, there is, and we see it from our point of view. We wouldn't go to the US. We can't afford the US. We wouldn't get the same return out of the US. And if what we're really looking for is the product, then we would look for a different jurisdiction.
All right. So I guess my question is, how do we manage all of these, I suppose, conflicting needs? So, we have the geopolitic issue, we have kind of the regionalization trend, and also the need to invest to grow supply. And so how do investors manage manage that?
There's a bit of a problem globally where 84%, 84% of the world's energy comes from fossil fuels or hydrocarbons. And we've been asked now to transition into some future metals. So just the logistics of that, if you think about it, is kind of mind-boggling. For the last 200 years, humanity has actually built everything you see around here pretty much based on fossil fuel energy, right? All these structures, your clothes, the carpet, synthetics, it's all petrochemicals, fossil fuels. So our whole industry, our whole existence for the last 200 years has pretty much been fossil fuels. And now we're asked politically or ideologically to change all that and get to, for example, these UN targets of net zero by whatever number, 2050, it doesn't really matter. That's kind of an impossible task. I know it's called an transition, but I think to take that 84% and bring it down to close to a zero, it's practically impossible for a number of reasons. I mean, one's economics, but two is also the amount of resources that are needed to affect that transition. But I think importantly is you actually have to still produce a lot of coal, a lot of hydrocarbons, a lot of fuel to get to that transition. So it's kind of like you have to spend money to make money. What I mean by that is if these groups that are saying no to coal at the moment or stop oil, if we did do that, you'll never get to that transition point. You need to actually, and you see, Ian touched on that, in China, the last few months, China's, I think, imported and produced more coal than they ever have last quarter. And that's the reason. It's not about, you have to actually produce more energy to get more wind turbines, solar panels, and that's not coming from the current renewable energy source, because that still probably only accounts for 10% of the world's global energy, and in China it's probably even less. So despite everyone's best efforts, I think the biggest problem is this transition, and it's kind of like a square peg in a round hole, and it's not happening because there's obviously a dichotomy between ideology and reality, and I think that's the case. So, like, if you look at it from an investment point of view, if you believe that story, you'd want to invest in any commodity, right? You'd obviously put your money in nickel, you'd put your money in cobalt, manganese, bauxite, aluminium, but also coal and oil and gas, because you actually need that. And I know, as a financing point of view, I've tried to finance some hydrocarbon projects in the last 12 months. Out of Australia, it's almost impossible. I mean, it's almost impossible. So people are either getting the memo and not really thinking it through, but I find that's interesting. So there's an opportunity, right? I mean, when no one wants to finance something that you still need, something's going to break, right? And that's why there's been a lot of private credit in the market, and those guys are making a lot of money. It's not your Commonwealth Bank or your HSBC now that's saying no to coal because of some ideological or shareholder issue. So there's a private credit guys that are making a lot of return on investments in financing that. And on the lithium side, you probably get every bank out there that's happy to finance a lithium project. But I mean, how many good ones are out there, and how many banks are going to lose their money financing a lithium project at certain high costs, and not so much return on equity, I think, especially with the current lithium price now. Long term, you should be okay. So I do see there's a bit of a disconnect, and that's from my point of view, an investment group. That's where I see the opportunities. When there's a bit of a uncertainty in the market, or everyone follows this direction, sometimes you need to see why and approach it that way.
Yeah, I mean, I'd certainly agree. We've got a large coking coal asset, and the reason we acquired that asset was because we saw that we could acquire it at a relatively cheap multiple, get quite a lot of cash flow out of it. On the flip side, the financing cost for it, I mean, we've been successful in getting Southeast Asian banks involved, but it was very difficult to finance that asset out of Australia. And when we were looking at credit funds, we were paying, sort of 14-15%. And that's why, the likes of Whitehaven, for example, and they've been very successful in recent M&A, have had to turn to the private credit markets as their thermal coal dominance. And that is an opportunity for investors. So we certainly feel very bullish on coking coal. Well, the reason we like it is because we literally see all of the restrictions of the governments. There's not going to be a lot of new mines. So basically, supply is going to be restricted going forwards, or new supply anyway. Yet demand we don't see particularly changing. So we actually like looking at some of the commodities which are call it a little bit out of favor, or not particularly on that sort of ESG spectrum as you may think, albeit you end up with you do have to adjust your cost of capital. So that's a comment I'd make there. I think, more broadly, and it comes back to some of the themes we were talking about earlier, when we're looking at investments, we have to be very conscious of the geopolitics. We are not buy and hold people. We are buy and exit people. We're looking at 5, 6, 7 year time horizons. So, you very much have to be conscious of the fact that if you're looking to exit an investment, you don't want to exclude a class of investor or a country. So again, we have to be very careful around where we're actually selecting assets and in what commodities. So we bought a copper mine in Zambia, which we, for example, recently exited to a Chinese investor. So that's another way we're certainly thinking about it in jurisdiction and who can actually buy there.
All right. We also see. So I used to be in banking as well, and I've seen that there's been a major shift from banks actually financing projects at an early stage, and more of a shift to financing majors or even traders. And in our little microcosm of chrome ore and stainless steel, we've seen that you can borrow from Glencore, who is able to borrow from its bank, but you cannot borrow directly from the bank. So now we've seen there's the likes of Cargill, again, we mentioned Glencore, and other traders, other majors still acting as intermediary banks for the banks, because they look at the credit rating and say, you can do whatever you want. It can be like a cobalt mine in the middle of the Congo. And that's an extreme example, but what they are able to fund, the banks don't touch, but they're still funding it through them. And we've also seen vendor finance. We've seen financing from shipping companies. We had a project, because in our mind, a project is not just the mine, because we are concerned about how to get it to the end user, in most cases China. So we are now working on a joint venture project with DP World, because it's part of the chain. They have funding. They want to put funding. The shipping companies want to put funding. The trucking companies want to put funding. The traders want to put funding. So you are able to get away from going directly to a bank to fund a new mine. And also, because we work out of South Africa, we don't actually have many banks to work with to begin with. So that other pool of funding has been quite active from where we see it. And yeah, I don't see that changing. However, if they look at the world the same way we look at the world, then they wouldn't be investing like BHP in like a 10-year project. They would look at something a lot closer to 1 year from production. But when you get a year from production, I think there's more pools of funding than just banks.
I thought we could talk a little bit more about those various sources of funding and who's, as you said, there's such a diverse group of people that are looking at the market. So how can the industry kind of attract a bit more of this diversity in terms of funding to kind of make sure that we are covering across all of the commodities that need funding at the moment?
Okay, so traditionally, most mining projects were financed by 101 project finance. So you go to one of your banks, HSBC or Standard Chartered, and that was 101, and it was great because the bankers kind of did all their due diligence and structured a 5-10 year loan, and financed paid that loan through the cash flows of the project. What's happened, and this goes back to the whole transition thing, is when I was an investment banker, I was the head of mining and energy for Asia at Credit Suisse, and I covered everything, coal projects, LNG projects, gold projects, iron ore projects, base metal projects. And that was more than 10 years ago. And that was my portfolio. So because we were successful, I had 10 mining bankers working for me, and that was specialists because we had a budget. We were doing all these deals. I'm actually thinking today, if I was a banker, what could I finance? I can't finance any LNG projects, probably. I can't finance any coal projects. A lot of the mining projects have got ESG issues attached to it. And then you've got geopolitical things. So if I'm sitting there as a mining specialist banker, I haven't got that many deals to do. You got the odd gold deal. Every 3 years, you might have a base metal deal, like a lead, zinc, copper deal. You might have an iron ore deal once every 2 years. But that's not feeding mouths. So what happens is that banking group has gone from a team of 15 to probably 3 guys, and 2 of those guys are very junior. So there's a problem in financing, because you go to your bank and you've got a couple of guys that are just green behind the ears and they don't know what to do, and they haven't got the team to do. So they just pick the low-hanging fruit because there's only 3 guys working on it. So they actually just pick the most easiest deal, which is what you said. Just do a deal with a Glencore or a BHP, because you don't have to even do too much credit analysis. But in my days, you had to actually go to the mine and visit it, do the due diligence, look at the cash flows, look at the insurance, take a view on foreign exchange and all that. These bankers don't do that anymore because that's what's happened. So the money now, the finances have actually moved into private credit, into groups like Damian's EMR, private equity, and that's where it's gone.
I'd just say, I think, when you're looking at new projects now, the complexity of assembling the capital stack has just gone up. So you can't go to a bank and you can't just go to the equity market. So the complexity is up there hugely, and that's tough for companies, right? When you're trying to get going, you're trying to finance it. We've seen financing come in, as we said, from the traders. The other one certainly has been, some of the automotive companies who've come in with prepays, etc., and that's been quite an attractive source. But that is the challenge. It is literally, you've got to look in a lot of corners and try and assemble that capital stack, and then people want structured paper, rather than necessarily straight equity. So it's got a lot more complex for companies. I think there is capital out there, but it's not simple to assemble or get, and you've got to look in some more niche areas.
Same, I agree with the rest. As I said, there are pools of funding out there. It's just not the traditional banks. And even though I remember like 15 years ago, Chinese banks were quite active, but even now, we don't actually see Chinese banks funding direct. They would fund a Chinese company, and the Chinese company would do the investment, because same way Western Bank would be funding a Glencore or a Traffic. But as I said, we're seeing it from our point of view, which is Southern Africa, which is a bit of a different beast altogether. But there are pools of funds. We haven't seen a good projects. When we see good projects, we have to fight for them, right? When they're bad projects, they're trying to pool funds together for a long time. Then there's a reason why they can actually. But I still see there is a lot of available funding sources for good projects, just not the traditional ones.
Another distortion, of course, now is all the government financing that's available, right? For years in this industry, through the 2000s and early 2010s, you go to any conference in Europe or US, and all the producers are complaining, how can we compete against China, government subsidies, all that. Now, you look at the steel industry, for example, green steel. Everyone's got their hands out for government subsidies to, we'll shut down if you don't give us enough money, but, we'll just build a new furnace and reduce the emissions or something if you do. And then equally, a lot of the projects now, the kind of safety, security angle, with all the states starting to worry about security of supply on a lot of key materials and stuff. So now it's a lot of the projects have become, okay, maybe they're not good enough projects to get market financing, but I'll just go to the governments and try and push that angle. So that's another kind of thing that it was not in commodities until the last few years, really.
I've got a question there. So because it's a genuine question. So is there any view of the American government getting involved in any of these mining investments? Because I mean, the naive view that the American government can print money, but you don't see them actively investing in any type of commodity other than oil onshore. So why is that? Why would someone explain that? Whereas the Chinese government is actually quite active to support securing those resources.
Yeah, I mean, I'm not an expert in terms of the
Yeah.
actual execution side there, but I just say you've got a lot of governments offering different kind of subsidies. So you've got state level ones, like Australia, Japan, US, where there are clear grants available for projects which have either got an ESG angle or a security of supply angle. So I think they tend to be more grants rather than investment. Or of course, tax breaks is the bigger thing. If we'll just give you a favorable tax funding, or of course the US thing was always a state by state competition, just going to the states and say, what benefits can I get, tax discounts or anything at a state level.
I mean, I'd say that certainly the DOE programs focus more on midstream and less so on mining in the US. The DoD funding can go into mining, but these are limited programs at the moment. If you look at the DOE grants. I think it was 27, 28 projects awarded on Friday. I've not been through them all yet, but I mean, they're generally more sort of processing type stuff rather than upstream mining. Australia has made some programs available for mining. You're seeing that, and there's a program in Queensland, there's a program run out of the Northern Territory, etc. So it comes to the point that there is capital. You've kind of got to go and find it, right? So.
I think that's a good place to end on a slightly hopeful note that there is capital. It's just a matter of finding it. So I want to thank our investment panelists for joining us for the opening panel this morning. So